Welcome to the deep dive. Today, we're not just, reading textbooks. We're moving past the theoretical concepts of investment. We're diving headfirst into the high-stakes reality of professional application. We're really looking at that moment when all that complex financial knowledge has to be synthesized, tested, and actually used to provide sound real-world advice.
That's exactly right. Our source material today is, well, it's essentially a blueprint for expert financial thinking. It's a strategy guide designed to prepare professionals for the kind of rigorous application required for the AFAI certification.
And for anyone who isn't familiar, the AFAI, the Associated Financial Advisors, is a pretty high-level assessment.
It is. It moves far beyond just recall and focuses entirely on application. This is about moving from knowing what an investment is to knowing why and how it should be deployed for a specific person at a specific time.
And our mission for you, the listener, is to extract those core principles that define successful financial advice. We're looking for the specific skills needed to construct logical, suitable, and well-reasoned investment responses.
It's like we're giving you a shortcut.
Exactly. A shortcut to understanding the foundational competence required to be a truly effective advisor, whether you're taking the certification or just trying to manage your own complex portfolio.
We're stripping away the exam pressure and just revealing the structured methodology, the kind used by top professionals when they have to synthesize complex information under pressure. This deep dive should really offer some clarity on that process.
Okay, so let's jump right into it. The fundamental measurement. What does this kind of assessment, and frankly, good advising in general, what does it actually measure? The source emphasizes, crucially, that the exam absolutely does not test memory alone. So if you can't just recite definitions, what are you demonstrating?
Well, you're demonstrating the ability to integrate information from all these diverse fields. What's being tested is the ability to analyze, interpret, and then apply investment principles in complicated, messy, real-world scenarios.
So that's why it's all case studies.
Exactly. The entire structure revolves around detailed case studies and client narratives. The goal is to force you to draw upon the full spectrum of your knowledge all at once.
Which is immense, right? We're talking about connecting dots between asset classes, portfolio construction, concepts from behavioral finance, ESG.
Suitability mandates, investment taxation, broader economic influences.
All at the same time.
Yep.
That sounds incredibly demanding.
It is demanding. And it's because it requires a holistic assessment. You have to prove the practical utility of all that knowledge. So if you understand behavioral finance, you need to show how a client's recent panic decision influences your current strategy. If you know about tax, you have to justify which wrapper, which investment structure makes the most sense for this client's long-term tax goals. You have to demonstrate the ability to think like an advisor, but under pressure.
So if the assessment starts with a dense client narrative, let's unpack that first and most crucial step, absorbing that story. Before you can apply a single investment principle, what specific meticulous details do you have to pull out of that situation?
You need to surgically extract the foundational elements, the ones that frame the entire recommendation. The client scenario will always include their articulated goals, their aspirational objectives, their current financial position, their measured risk profile.
Their time horizon, of course.
Their defined time horizon, and any specific personal preferences or constraints.
That sounds like we could be dealing with pages of data. How does a successful advisor or candidate avoid getting totally bogged down in, background noise or red herrings?
This is where the critical sorting task comes in, and it's where a lot of novices falter. Successful candidates understand that they cannot just rush into solutions. They have to first impose some structure on the narrative. They do that by identifying three things: the client's precise objectives, their relevant constraints, and their preferences.
Can you give us a concrete example of that filtering process? Like, what's the difference between a relevant constraint and just noise?
Certainly. Let's imagine a client scenario. An experienced professional, we'll call her Sarah. She's 55. She states her primary objective is retirement in 10 years. So her constraints immediately become critical. Her time horizon is medium term, and her capacity for loss is high because her earning power is still strong, but she's getting close to that preservation mode.
Okay, that makes sense. So where's the noise?
Now for the noise. Sarah mentions in the narrative that she recently bought a classic car collection. That's interesting context, maybe, but it is noise unless she's funding the car collection from the investment portfolio.
Or if the collection is a huge part of her net worth.
Exactly. Or if it represents a material percentage of her overall net worth.
I see. So if the investment strategy question is purely about funding her retirement, the car collection is basically irrelevant context. But if the question involves asset allocation and her overall net worth, that car collection suddenly becomes a huge illiquid asset, one that significantly affects her diversification and her real capacity for loss.
Precisely. Rushing into solutions without clearly defining objectives, constraints, and that suitability boundary, that's the most common mistake. You have to filter the signal from the noise before you even think about asset allocation models. You have to establish which facts are central to suitability and which are merely context.
Okay, so once we've successfully filtered that noise and established a tight client framework, time, risk, goals, the next step is connecting that structure back to that huge library of theoretical knowledge. And this is where it gets really interesting. How do we make those confident, explicit connections between theory and practice when we're under pressure?
That's the application checklist. Advisors must quickly pivot their knowledge base to match the angle of the question. We can break that pivot down into 3 application pillars: risk, product choice, and justification.
Okay, let's start with risk. If the question focuses directly on risk management for Sarah, what are the 3 immediate and explicit connections an advisor has to make?
They must immediately address the 3 distinct components of risk. First, volatility. That's the mathematical measure of how much an asset moves. Second, capacity for loss. This is the measurable financial reality. How much money can this client actually lose before their core lifestyle or their primary objective is jeopardized? And third, risk tolerance. This is the purely psychological behavioral factor. How does the client feel about all that movement?
That distinction is so key, especially in a professional context. You could have a 40-year-old client with enormous financial capacity for loss, but who went through a market crash early in their career and now has a really low psychological tolerance. The advisor has to explicitly acknowledge and manage that tension.
Absolutely. The professional response shows the analysis of all 3. You might recommend a portfolio based on her high capacity, but the structure has to address her low tolerance, maybe by using protective options or by ensuring high-frequency, clear communication to manage their fear. The source material emphasizes that a failure to address all 3 components results in a superficial recommendation.
Right. Now, let's pivot the application. If the question is more about the practical implementation, choosing the actual product or structure, what connections come into focus then?
Then we shift our focus to product choice. And the key pillars here are the investment wrappers used, the taxation implications of that choice, and the inherent liquidity of the product.
Can we just quickly clarify what an investment wrapper means in this context, just for absolute clarity for everyone listening?
Of course. The wrapper is simply the legal and tax structure that surrounds the investments. It's the container, if you like. Are the assets held in a taxable brokerage account, a tax-advantaged retirement account like a 401k, an ISA, or a trust? That choice of wrapper drastically affects the net return and the accessibility of the funds.
So for a client like Sarah, with a medium-term goal retirement in 10 years, the advisor has to connect that time horizon immediately to the tax implications of the wrapper. You might optimize for tax-deferred growth, but you have to ensure the liquidity is still appropriate.
Precisely. For potential unexpected expenses or life changes. If the product is highly illiquid, it becomes unsuitable, regardless of its performance potential, if the client has a reasonably predictable short-term need. The application pillars for product suitability wrappers, tax, and liquidity, they all have to align with that client structure we established earlier.
And then finally, when you're asked to justify recommendations, which is really the ultimate goal here, the application focus shifts one last time.
Yes, and the justification must draw directly and explicitly on the suitability assessment. It has to align with the specific client goals and respect that defined time horizon. You know, the source stresses that knowing the definition of diversification is just entry-level knowledge. The expert response has to explain how the proposed asset allocation diversifies this client's specific portfolio, showing that you've considered their existing assets, like that classic car collection, or maybe their business holdings.
That makes perfect sense. Now, let's talk about communicating this whole complex thought process. The examiner is looking for clear, structured reasoning, but warns emphatically against writing long, rambling essays. So how do we achieve that perfect balance of detail and efficiency?
It comes down to surgical precision and disciplined structure. Your answers have to flow logically and address the specific requirement, and only that specific requirement. Time is the advisor's most critical resource. in the exam hall and in real life. If you are asked for 3 advantages of a particular investment vehicle for the client's objective, you provide 3 distinct advantages.
And you resist the temptation to explain the history of the product or its general mechanics.
Absolutely. That's what the source calls padding. It's a total waste of time, and it's an indicator of poor focus. If they ask for analysis, you have to go beyond just listing features. You have to explain how those features specifically support or undermine suitability in the client's situation. For instance, stating that bonds are safe is a feature. Analyzing how the addition of high-grade municipal bonds, which offer tax-free income, improves Sarah's post-tax cash flow while reducing overall portfolio volatility in her pre-retirement window. That is analytical justification.
Precision, then, is directly tied to efficiency and ultimately how many marks you get.
Correct. Every mark is weighted the same, and time management is a brutal constraint. Spending 10 minutes writing a perfect, detailed paragraph for a 3-mark question that only needed 3 succinct bullet points is a critical mistake. That's just self-sabotage. You've earned 3 marks, but you've potentially lost 15 minutes you needed somewhere else. Strong answers identify the key points quickly and articulate them clearly and concisely. The professional advisor is efficient, not exhaustive.
This sounds less like a knowledge test and more like a test of technique and discipline.
It is entirely a test of technique under pressure. Practicing with mock questions helps candidates immediately recognize common question patterns. The structure of the scenario often dictates the structure of the answer. That preparation builds the automatic technique and recall needed to execute quickly and calmly when the real assessment begins. You train yourself to see a client's cash flow constraint and immediately apply the liquidity and tax billers.
Okay, let's move to the highest level of thinking required here. Qualitative judgment. We know that complex, real-world client scenarios rarely have a single, perfect answer that's just carved in stone.
That's the reality of advising, isn't it? Professional judgment is necessary when you have competing considerations. An advisor often has to balance, say, aggressive growth potential against the desire for stability, or maximizing flexibility versus achieving immediate tax efficiency. In these situations, there is no purely objective mathematical solution. You're trading one good outcome for another good outcome.
So what does the examiner, or, a real-world compliance officer, what do they reward when they're faced with that necessary balancing act?
They reward reasoning that is balanced, fair, and most importantly, comprehensively aligned with the client's stated needs and measurable capacity. It's not about finding the definitively right answer in a vacuum. It's about demonstrating sound professional judgment, showing that you weighed the pros and cons relative to the client's unique, nuanced situation. You have to explicitly state the trade-offs that are being made.
And this brings us right back to communication clarity, especially when you're discussing difficult trade-offs. If you're dealing with a complex balancing act, you have to communicate that rationale clearly to both the examiner and the client.
Absolutely. The source advises avoiding financial jargon unless it is absolutely essential to the explanation. And if you must use a technical term, you should probably define or contextualize it in plain language. You have to write as you would speak to a real client. This demonstrates true, deep understanding, not just rote memorization. If you can explain complex concepts simply, you prove you've mastered them.
Let's review those core foundational themes one last time, because they run through the entire unit and they reappear in every single stage of planning. These are the lenses that have to be applied to every decision.
The foundational themes are really the pillars supporting the whole house. It's understanding the relationship between risk and return, the necessity of diversification, the principles of strategic asset allocation, the central requirement of suitability, the influence of behavioral factors, the complexities of investment taxation, the growing constraints posed by ESG considerations, and the impact of broader economic influences. Every single investment decision for a client has to pass through those filters.
So what does this all mean for you, the listener, whether you're pursuing certification or just aiming to be more knowledgeable about expert financial thinking? We've seen that the skills required here, analyzing client needs, interpreting market principles, balancing competing risks, and communicating clearly and efficiently, they really reflect the actual day-to-day responsibilities of a world-class financial advisor. It's a structured approach to solving human problems with financial tools.
It's the difference between collecting knowledge and executing strategy. At the end of the day, success comes down to the ability to apply those core principles with relentless clarity, structured thought, and suitability, all underpinned by disciplined revision and calm, thoughtful execution. That structure is what separates the informed novice who knows the definitions from the professional expert who knows exactly how to make them work.
That leaves us with one final thought for you to explore as you process this deep dive. If the ultimate goal isn't just to be right, but to show sound professional judgment when balancing competing considerations, like maximizing growth potential versus ensuring essential stability, how does the advisor ensure their judgment remains impartial and objective? Especially when facing scenarios where the client's stated preference, their high-risk tolerance, conflicts deeply with their measured objective capacity for loss. That tension where the financial structure meets the human element is the highest challenge of all.
Something to ponder until our next deep dive.